Assalamualaikum, everyone. Today is September 5th. Welcome to Wall Street to Bay Street, Sunday Chai with Sherry Portfolio Canada. My name is Nadeem Mian.
And my name is Shamil. Get your chai ready, and let's get into the news.
Let's
So, Nadeem, let's get right into this here. So, we've been seeing a lot of news and headlines coming from China, and we've seen that the Chinese markets have been falling quite a bit this year. So, why don't you kind of tell us a little more about that to start us off?
Yeah, sure. I mean, China's obviously been in the headlines for all the wrong reasons. First off, the Chinese market has significantly underperformed this year, even when you compare it to the S&P 500. The Shanghai Shenzhen Index, which has 300 of the largest Chinese companies, that's significantly down, as well as the Hang Seng Index, which is the Hong Kong market. A lot of what's pretty much been driving the markets in China has been really the government kind of cracking down, and it really kind of starts from President Xi. He's running for a third term here. The view is that he wants stronger control on this Communist Party, and he also wants to kind of calm his just any discontent in terms of the public in general, even though it's not a democracy. So at the end of the day, it looks like China's communist roots are kind of coming to surface. Over the past few years, what we've seen is Chinese billionaires, and the Chinese government has kind of helped a lot of these lead the Chinese tech revolution. And so you've got the Jack Ma's of the world that, are these Chinese billionaires. And now what Beijing is trying to do is just trying to create some type of social equality. So, as a result, it's kind of, created some stuff such as, for example, the government really wanting having tighter control around it. We're talking about, banning some foreign IPOs. Earlier this year, Alibaba was going to be spinning off a company by the name of Ant Group. The Chinese government kind of put a stop to that. And at the same time, it's not just social inequality. It's also the fact that a lot of the Chinese companies that are being targeted are tech companies. And these are companies that are, we're talking about companies with information, companies that have the ability to drive social media and in turn, drive, public behavior, so to speak. So, again, it's a lot of this has to do with the government of China unilaterally, making this decision to create social equality, and at the same time, and also in the name of national security when it comes to information and movement of capital.
Yeah, so one of the when we're talking about the Chinese markets, one of the big things that comes up in a term that's used quite a bit is American Depository Receipts, or ADRs. So, for those who might not know, can you maybe walk us through what that means or explain a little more in detail?
Sure. Basically, an American Depository Receipt, ADR, it's a certificate that's issued by a U.S. bank that represents shares in a foreign stock. These certificates, they trade on U.S. exchanges, mostly in New York and in NASDAQ, and they are priced in U.S. dollars, and they even pay dividends in U.S. dollars. Essentially, it is a corporate structure, however, and to kind of simplify it, really what it is you'll have, for example, a Chinese company that trades in China. A local broker there will buy the shares. They'll take the shares, they'll put it into a custodian bank, and then a local bank here in North America will issue receipts to the custodian bank, right? So a little bit of there's a corporate structure involved. However, for the most part, these ADRs, they are the level 2 and the level 3, which are the ones that trade on the New York and the NASDAQ. They are subject to SEC rules and regulations and financial requirements. But that is kind of been the way that we here in North America can invest into Chinese companies.
So, kind of following up on that, with the Chinese companies that are on the U.S. market, what would you say is the risks or the chances of, if some of these companies being delisted from the market, which has been a pretty big headline in the news as well?
Yeah, I mean, as far as chances goes, well, one thing I can say probably is the market is obviously looking at that as a risk, right? And that's one of the reasons why, or probably a main reason why these prices are the way they are. Like fundamentally, the Chinese economy has been good. I mean, some of the numbers that have been coming out of China have been maybe not great, but they've been good. And as far as some of the specific Chinese companies, whether you're talking about Alibaba, Tencent, or some of these other, their top lines have been growing at about 10 to 15%. So again, consumer spending in China is relatively strong. These Chinese companies that are listed here in as ADRs, they're showing business that is relatively, again, strong. But what we're seeing is that the price isn't reflected. In some cases, they're down about 40% or so from their high. So really, what it is, I think the market is looking at the whole delisting as a factor, or as a risk. Sorry. And it's even led to SEC Chairman Gary Gensler warning many U.S. investors that they're not aware of some of the risk embedded in these Chinese ADRs.
Perfect. And I guess the last question I had for you was, if you're an investor, what advice would you give to someone looking at, potentially investing in the Chinese market?
Well, first of all, we would recommend that you do speak to your financial advisor on any financial advice, and not take what we have to say as financial advice. What we can tell you as far as what Share Portfolio Canada is doing in terms of the Chinese market. Well, currently we don't own any ADRs in any of our actively managed portfolios. We would rather kind of wait for the dust to settle and at that point, maybe see how everything plays out. There are different ways. For example, if you are, say, bullish on China and you want to invest in China, I mean, there are different ways to do it. For example, typically, historically, when China is the largest consumer of materials and metals, typically in the past, when the Chinese market or the economy is doing well, their commodities tend to follow that cycle. That doesn't necessarily mean that it's going to play out in the future, but nonetheless, I mean, there are other ways to maybe look at trying to kind of play China, so to speak.
Perfect. Yeah. So I mean, that was pretty much all the questions and topics we had today. So as always, thank you guys for joining us. And if you have any questions, feel free to leave them in the comment section below. And once again, from Nadeem and I, we'll see you next week.
Thank you. Assalamu alaikum.
Nadeem Mian, Portfolio Manager, registered as an advising representative, and Shamil Devji, Financial Advisor, registered as a dealing representative with Sharia Portfolio Canada Inc., a portfolio manager registered in the provinces of Ontario, British Columbia, and Alberta. Their opinions and statements expressed in this show are their personal opinions and do not necessarily reflect those of Sharia Portfolio. They are effective as of the date of this broadcast only and are subject to change. This discussion is for general information purposes only and is not investment advice.